So my topic for today is corporately owned segregated funds and tax and estate planning. I know that many of you will be familiar with segregated funds and ownership when it's owned personally, but I know sometimes seg funds owned by corporation can be a little bit confusing for people. So this presentation is meant really to kind of walk you through, what that looks like, and we'll throw in a little bit of tax and estate planning as well. So why don't we jump right in? All right, there we go. Okay, so just a little bit of housekeeping. Reminder to everyone that today's presentation is not to be taken as tax, legal, or financial planning advice. It's strictly provided for informational purposes only. We always recommend, if you have a specific question, that you reach out to the appropriate advisor to get assistance. On the agenda for today, we will start off with a scenario, a fictional couple that I call Barney and Betty. We are going to kind of learn a little bit about them and walk through corporately owned segregated funds with this couple. We'll look at the why of corporately owned segregated funds. We'll also take a look at the contract setup. How do you, set this up correctly, and what are some traps or pitfalls to be aware of so that you have the right setup. We'll talk about will planning because in the particular strategy I'm going to lay out, will planning is a big part of that. And so we'll go into some detail on that, a little bit about, we'll talk a little bit about probate, and then we'll wrap up with the taxation of segregated funds. Okay, so this is Barney and Betty. Now, Barney is a retired doctor. He sold his medical practice last year, and he's also the sole shareholder of a Holdco that actually holds the proceeds from the sale of his medical practice. He sold that practice for 1.5 million. That was in terms of net dollars, that's what he received. And in his Holdco, so he's got these proceeds in cash, and he's also got some low return investments, GICs, for instance. Now, Barney is married to Betty, and they have 2 adult children. So a little bit more about Barney. He wants to ensure that the proceeds from the sale of his practice are protected and that they'll provide a future income stream for Betty upon his passing. Barney also wants to protect the capital, but would love to take advantage of market upturns. And he also wants to benefit from tax efficient planning. So what is Barney to do? Enter stage right, corporately owned segregated funds. So I'm going to lay out why it would be useful for Barney at a minimum to consider corporately owned segregated funds as opposed to having that mixture of cash and GICs sit in his Holdco. With corporately owned segregated funds, there is a great planning opportunity. And I'm sure for many of you, you'll find that you have clients who are small business owners. They may also be retired professionals who hold surplus corporate earnings in GICs and other short-term investments. And generally, clients will do that to protect their capital and to avoid market downturns. That's common. And we know that with GICs and other short-term types of investments, they do provide protection of capital and easy access to cash. However, the low rates of return may actually prove problematic. And I'm hearing the voices out there saying, well, why would that be? Where's the problem? Well, in 2021, Ryerson University's National Institute on Aging put out a study and found that 79% of Canadians 55 and older fear that they will not have sufficient resources from income to retire comfortably. And when we're talking about resources from income, that includes pension income, savings from RSPs and RIFs, old age security, all of those kinds of sources of income. There is concern that they will not have enough. And one of the issues that's out there is that Canadians have to be thinking about financing a longer a longer time horizon in terms of retirement. We are living longer as a population because of medical advances and healthcare and higher standards of living. And so the concern for lots of Canadians is, am I going to outlive my savings? And how can I make sure that they're going to last for my lifetime? That's a big issue that we're currently facing. And so considering other investment opportunities that would provide larger returns is definitely something that I think clients would be interested in hearing about. So that leads me to encourage all of us to be considering segregated funds as opposed to GICs and other short-term investments. With segregated funds, of course, there's an opportunity to participate in equity market growth. You also have protection of capital through guarantees and tax efficient distribution to your surviving spouse. And we're going to talk in some more detail about what that looks like when seg funds are being held and owned by corporation. There is an opportunity to benefit from higher investing and guarantees of a segregated fund through this procedure that I've laid out here. What it involves is using a corporation's surplus cash and or short-term investments to make a deposit into a segregated fund contract. Following that, the shareholder of the corporation can and should be named as the annuitant, with the corporation named as the beneficiary and also as the policyholder of that seg fund. And then the final part of this would require either preparing or updating a will to ensure the transfer of shares from that corporation to a surviving spouse. And I'm just giving you a very high level overview of what we're going to spend some time delving into much deeper, but I wanted to just share a little bit of an overview with you on that. So let's look at the setup of a segregated fund when it's corporately owned. How would you actually set that up? I know for lots of people, generally when you have a seg fund, it makes lots of sense. If it's being held personally, it's common that a spouse would be named as a beneficiary, for instance. But what does it look like in the case of a corporation? So first off, let's consider this. Can we not simply name a spouse as the beneficiary of the seg fund? And of course, that would make a lot of sense. Barney is wanting to set up this, well, he's got his investments in his Holdco. He's hoping to take advantage of increases in the market. He wants to protect his capital. Now, so it would be great if there was a way to, set up a seg fund, for instance, and just name his spouse, Betty, as the beneficiary. Would that work though? In terms of the setup, we could have his Holdco as the policyholder. He would be named as the annuitant because he's the shareholder, and so that's the measuring life. And then if we wanted to name Betty as the shareholder, that would be nice and neat, right? Because we name Betty as a shareholder. When Barney passes away, she gets, this cash payout. Would that actually work though? Are there any negative tax consequences? And the answer is yes. So pursuant to the Income Tax Act, it's with Barney naming Betty as his beneficiary, it's likely to be considered a shareholder benefit. The reason being that the premiums on the seg fund would be paid by the Holdco, so corporate dollars are being used to pay for this. As a result of that, if you name anybody related to Barney as a beneficiary, that obviously leads to a benefit for him as the shareholder. And so that would result in a negative tax consequence. That shareholder benefit could not be deducted in terms of the tax that would be that would come from that. And so that will not work. Let's look at another scenario. Let's say that Betty also has a Holdco for whatever reason. Let's say she's got a Holdco. And if we have Barney's Holdco as the policyholder, Barney is the annuitant because he's the shareholder. What if we named Betty's Holdco as the beneficiary. So it's not going to Betty, it's going to her Holdco. Holdco to Holdco, does that work? And of course, the answer is that doesn't work. Is there a negative tax consequence? Yes. Again, you've got the same issue. There's going to be an indirect payment in terms of the funds from that segregated fund being paid out to Betty. Of course, she's not getting that money directly, but because it's being paid into her Holdco, that is still considered a shareholder benefit for Barney. And so that does create a negative tax consequence that will not work. And it's, I mean, you could do it, but from a tax perspective, tax efficiency perspective, it's certainly not recommended. Finally, let's look at naming Barney's Holdco as the beneficiary. So you've got, again, his Holdco is the policyholder, Barney is the annuitant, and then the Holdco is named as the beneficiary. Does that work? And I have no here to answer, is there a negative tax consequence? There is not a negative tax consequence. However, setting the policy up in this way where the beneficiary is the Holdco means that there's no shareholder benefit being conferred on Barney. So ideally, and that's kind of the big takeaway, when you have a corporation that owns seg funds, it's important to avoid a negative tax consequence that the policyholder, the beneficiary, are the Holdco, that you name the Holdco in those two ways. What happens is when Barney passes away, the death benefit is retained in the corporation because the corporation is the beneficiary. Those monies would be paid to the corporation. Of course, the question then becomes, how is Betty actually going to access these funds? And that's, we'll talk about the use of a will now and how that would actually assist with helping Betty access those funds. So just in terms of a summary here, the structure before Barney would pass away, if he's the sole shareholder, then he's going to name his Holdco as the policyholder. So the Holdco owns the segregated fund contract, pays for or deposits the funds into that contract. Now, of course, if Barney and Betty were actually joint shareholders in his Holdco, that would work as well. You could have both of them named as the annuitant. That also works. And then when either person passes away, or if it's just Barney as a sole shareholder, when he passes away, the Holdco, the proceeds from the segregated fund obviously get paid to the holding corporation because it's the beneficiary, and Betty is going to have access to those funds. Of course, the question now is how, because she's obviously not receiving them directly. So let's look at how that could happen. So depending on what part of the country that you're in, you could use primary and secondary wills to ensure that Betty has access to those funds in Barney's Holdco. Now, the way that would happen is that through Barney's will, he would have to transfer his shares in his Holdco to Betty. That's actually how she gets access to those funds. I want to spend just a few minutes talking about primary and secondary wills and the dual strategy. If you're in Ontario or British Columbia, then you would have an opportunity to take advantage of this planning strategy. If you're in other parts of the country, then because probate fees are so much lower in other parts of the country, there's really, this dual will strategy is not really applicable. It's not as important just because the fees aren't as much of an issue as they are in Ontario and in British Columbia. So first off, to back up just a bit, in terms of probate, when a person passes away, any assets that were held solely in the name of that individual will require probate if they are of a specific nature. So for instance, real estate, so if a person passes away and they own a piece of land, or they own a home solely in their name, not as a joint tenant with right of survivorship, with a surviving spouse, for instance, but property that's owned solely in the name of an individual would normally require probate. And really what probate is the local estates courts where a person has passed away, verifying that the will of a deceased person is in fact the final last will of the person, and the individual that they've named as executor is actually the right person, and they have the authority to actually act as executor and administer the estate. That's what probate is. It's really just a court approving a will of a deceased person. Now, not in all cases is probate required. It depends on the types of assets that are actually in the estate. So as I've indicated, real estate, if it's owned by a deceased solely in their name, then it would require that an executor submit the will to the local estates court where the person passed away to obtain probate. Publicly traded securities will normally require probate in order to be transferred to the executor and then transferred on to whoever the beneficiary is or beneficiaries are as per a will. Bank deposits, so if a person passes away and they've got $100,000, $200,000 in an account in, a major financial institution, generally a certificate of probate is going to be required before that institution will transfer those bank proceeds over to the executor. Normally, if they're, minimal amounts, so, if there's $100 or $10,000, there's usually a threshold amount that banks will allow to be transferred over to an executor without probate being obtained. But the larger the sum, the more likely probate is going to be required. And then any other assets held by third-party institutions will generally require probate before those assets are released to the executor. The issue, obviously, for provinces like Ontario and BC is that the probate fees are in general, in terms of tax, they're low, but the probate fees specifically are highest amongst the country in BC and Ontario. In Ontario, it sits at about 1.5%, and in BC at 1.4%. So if a person has assets that have significant value, obviously it's better if you can avoid having to submit that asset that has to go through probate where a probate fee is going to be levied against that asset. It's obviously better if you can avoid doing that, and there is value to the estate if you can avoid it. Hence, a secondary will. With secondary wills, assets that do not require probate can actually be placed in this will. And again, the good news is the probate fee will not be levied against that particular asset. So it can lead to significant savings. For example, if an individual has a privately held corporation, that let's say the value of that corporation is $2 million. In Ontario, for instance, an individual could save close to $30,000 in terms of the probate fee that would normally have to be paid if the person had just one will. If a person in Ontario had a primary will alone, all those assets then are in that will. It's got to be submitted to the court. A probate fee has to be paid before that probate certificate comes back. And so depending on the value of certain assets, it does make a lot of sense to include a secondary will if that is an option in the particular province that you're living in, and if it makes sense in terms of just from a cost perspective, because there are legal fees involved in putting together primary and secondary wills, and there are higher costs, absolutely, if you're going to engage in this strategy. So with secondary wills, assets that could be placed in a secondary will, again, include privately held shares, if there are shareholder loans or receivables, partnership interests, related loans and receivables, beneficial interest in trusts, or other estates, and also personal property. So jewelry, personal effects, artwork, antiques, an antique motor vehicle, any personal property that would have gold bars. I once worked with a client who had gold bars in her, like actual gold bars in her estate. And, these are assets that are appreciating in value. So any personal property that's got significant value to it does make sense to put into a secondary will. And of course, if you've got privately held shares, you would do that as well. So it just maximizes the effectiveness of using this particular strategy. So in the case of a corporately owned seg fund, what would happen? And let's go back to Barney and Betty. What would happen if Barney was living in Ontario, for instance? He would transfer his shares, his Holdco shares, to his surviving spouse, who is Betty, in his secondary will. So if he was in Ontario or BC, that's certainly something that I'd be recommending that Barney do. And then upon his death, when Barney passes away, the payment from the seg fund contract obviously goes into the Holdco. And then Betty, as the new owner of the shares, is entitled to access funds from the death benefit payment, because Barney has transferred his shares to Betty through his will. When he passes away, she becomes the owner of those shares. The good news is, because he's done it through a secondary will, there's no need for probate in order to, to become owner of those shares. And the money that's now sitting in Barney's Holdco, Betty can now access. Another another tax benefit that comes from this particular strategy involves the spousal rollover. And I want to speak about that very briefly. When a person passes away, pursuant to the Income Tax Act, there is what's called a deemed disposition. So basically the government presumes, or the law presumes, when a person passes away, that right before you passed away, you sold all your assets. And there's what's called a deemed disposition as a result of that. So any capital property, and that's property that either appreciates or loses value, if there is an increase in the value of your capital property, which includes shares in a privately held corporation, it is possible that a capital gain would become due and owing and payable. With a spousal rollover, there is a deferral of if Barney's estate decides, or the executor decides to take advantage of the spousal rollover, there is a deferral of the capital gains tax that would normally be owing and payable because of the spousal rollover, because those shares have been transferred to Betty. So that's also a great thing, that there's this tax deferred opportunity for these shares. And the tax would become owing, the capital gains would have to be paid when Betty either passes away or if she disposes of those shares. So if she sold them, if she gifted them, then the capital gains would have to be paid at that point. But there is that deferral until one of those two events does happen. So again, this strategy is effective and efficient from a tax deferral perspective. So if Barney has an advisor, what should the advisor be recommending or pitching to him as it relates to a corporately owned seg funds? Barney's advisor could recommend the Empire Life Guaranteed Income Fund 75-100 with a 100% death benefit guarantee. Barney's corporation or Holdco would be the owner of the segregated fund contract. Barney's the life insured. And of course, as I've indicated, Barney's Holdco would be the beneficiary. In addition, Barney's advisor should be recommending that Barney update his estate planning. And I've indicated here update, but quite frankly, it may require Barney actually have wills prepared. Working with clients where there could be an opportunity for clients to purchase seg funds through a corporation, it does also open up the opportunity to have discussions with clients about estate planning in general, because if Barney doesn't have a will, he should have a will. If clients don't have a will, in order for this particular strategy to be effective, having at least a will in place, if not primary and secondary wills, becomes vital to transfer those shares over to the surviving spouse. And so just being able to have that discussion with clients is really key and important. That opportunity comes just through pitching this strategy to clients. Again, the shares through a secondary will would be distributed to Betty, and who is named as the beneficiary of the shares. So once Barney passes away, as I've indicated, Betty would have access to the proceeds from the seg fund, the death benefit. Now, one of the other things that Barney can do in his estate planning is through instructions in a will, in his will, or even through a letter of wishes, which is just an addendum to the will, providing specific instructions. He could put a direction in there for the corporation to invest that $1.5 million proceed in a product that permits regular distribution of dividends to Betty, so that Betty, of course, as a shareholder, she would have the ability to take those funds out, in one lump sum, but for tax reasons, there are good reasons for those payments to be spread out over perhaps even 20 years. There are some tax efficiencies that come with that, as opposed to taking that payment out as one lump sum. So Barney could always put some instructions in his will with regards to that direction. And it could include segregated fund. Barney could put an instruction in for those proceeds to be used to purchase segregated funds with a systematic withdrawal plan, or even a guaranteed minimum withdrawal benefit plan, such as the Empire Life Class Plus 3.0. This provides Betty with access to funds as regular dividends over a 20-year period. And it also gives Betty an opportunity for access to tax-free capital dividends from the capital dividend account. And I'll speak about that in just a moment. I wanted to just show you this table here with the difference between the tax differentials if Betty takes this money out, withdraws money from from the corporation in a lump sum, as opposed to through a stream of dividends, and in terms of what the tax treatment might look like. In terms of a lump sum dividend, she'd be looking at a marginal tax rate on eligible dividends of 39.34%, as opposed to 7.56% if she wanted to receive these payments in a stream of 20 annual eligible dividends of equal amounts each time. In terms of total taxes payable on the dividends, you're looking at close to $600,000 on a lump sum dividend, as opposed to $113,000 if it's spread out over 20 annual equal dividends. And in terms of the after-tax amount to Betty, there's quite a differential here. On a lump sum, it's almost $910,000, as opposed to nearly $1.4 million. So absolutely something to think about in terms of lump sum versus a stream of dividends, and the benefits that come from having those payments spread out. Now, in terms of the capital dividend account, there could be in the future the possibility for Betty to receive payments from the Holdco through the capital dividend account. It's a notional account, but it allows the corporation to declare capital dividends, so the directors are able to do that, or the director of a corporation is able to do that. It provides for a non-taxable dividend to be received by a Canadian resident shareholder. So if Betty is the sole shareholder, that opportunity would be there for her. In order to receive that capital dividend tax-free, it would require credits to the capital dividend account, which come from the non-taxable portion of capital gains that are allocated by segregated funds, and then also the non-taxable portion of capital gains from the sale of segregated funds. These portions are added or credited to the capital dividend account, and over time, there may be enough of a credit there that would allow Betty to receive a non-taxable capital dividend from the capital dividend account. So let's now look at the taxation of segregated funds. So I want to step back just a moment to look at taxation in corporations. In terms of investment income, the aggregate investment income pursuant to the Income Tax Act includes the taxable portion of capital gains and income from property, including, for example, interest from GICs. Taxable capital gains are also included in that rate of 50%. Now, in terms of investment income, and that would include allocations that are made from segregated funds, the federal tax rate for investment income earned by a Canadian-controlled private corporation in Ontario, for instance, in 2021 is 38.67%. The provincial tax is 11.50%. So the combined rate, the federal and provincial rates there is 50.17%. And that just gives you an idea of what the investment income would be in the corporation. It is significant. If we turn to taxation of segregated funds specifically, segregated funds are considered to be like an inter vivos trust for tax purposes. And so what that basically means is that the insurer is deemed to be a trustee who has ownership or control of those of the funds. The policy holders are considered to be the beneficiaries of the deemed segregated fund trust. Now, in terms of the income that comes from the segregated funds, when income is allocated to policy holders, it's allocated in the same nature in which, how should I say this? The income in the segregated fund maintains its character. So whatever the income is that's generated in the segregated fund, when it's allocated to policyholders, it doesn't change. Like the segregated fund is almost like a flow through, and the income flows through in the exact same manner that it's generated in that seg fund to the policyholders. So what types of income are generated in the seg fund? Dividends from Canadian corporations, income from property, foreign source income, and then of course capital gains and losses. And both gains and losses are deemed to be the capital gains or losses of the policyholder. One of the benefits with segregated funds from a tax perspective is that capital losses can be used by the policyholder against gains that they may have. And so that can be useful in terms of tax planning for the policyholder. Now, a capital gain is realized when capital property is sold, and capital property is property that appreciates in value. Capital property is property that can appreciate in value over time. Of course, it can also depreciate or lose value over time. If a person purchases property and at the time that they're ready to sell that property or they pass away, the gain on that property is greater than what they purchased it for, then there is obviously a gain, and capital gains would be then owing and payable. Segregated funds are capital property, and the gains on a disposition of a segregated funds policy will give rise to a capital gain for a policy holder. And in what situations, I want to just point out what situations result in the disposition of segregated funds. Whenever there is a disposition of segregated funds, that may result in capital gains having to be paid. So if there's a partial or total withdrawal from a policy, that is considered a disposition. And if there is an increase in the value of that of income, then capital gains may be payable and owing. If there's a switch between funds, so if the investment manager switches, from one fund to another, that's considered a disposition, which may lead to capital gains being incurred. And then at the death of the annuitant, that's also considered a disposition. And again, that may result in a taxable event. So let's talk now about top-up payments as it relates to segregated funds. One of the benefits with segregated funds is that there are locked-in guarantees on your initial investment. If the markets are not performing well, and at the time of payment of, at the time of payment of a death benefit, if the markets are not doing as well as at the time that the initial investment was made, because of locked-in guarantees, a top-up payment may be required in order, to fulfill that guarantee. So in terms of the tax treatment on those top-up payments, under current legislation, it's not entirely clear how those top-up payments are characterized. CRA's position generally is of the opinion that the payment should be treated as a capital gain for the policy holder. But one important thing to pay attention to in terms of planning points is that in situations that involve top-up payments being paid, you may actually have two different tax consequences, which may work to just set each other off. So if markets are not performing well, you could characterize the investment as having a loss because the initial investment, now the value of that has gone down, so there's a loss as a result of that. But if we characterize the capital gain, if we characterize a top-up payment as a capital gain, what you would have then is the loss and the gain offsetting each other, and so there's no tax consequence. There's no negative tax consequence in a situation where a top-up payment has to be made. So we've also got some marketing material here that I would encourage all of you to have a look at in terms of this particular strategy that I've laid out for you with corporately owned segregated funds. Sandy would be more than happy to send this information out to you if you'd like to get a little bit more detail on specifics about how this structure works. One of the other things that I would say is that in using this strategy, certainly in my scenario with Barney and Betty, he's thinking about Betty and making sure that she's provided for, in the event of his passing. But this strategy could also be used with children, for instance. So if Barney has, and in the example I gave, they've got 2 adult children. If for some reason the adult children were also shareholders with Barney, absolutely, he could consider having them in his will, what he would do, as opposed to having Betty that receives his shares. The children could receive the shares in his will. Like if Barney didn't have a wife and he just had children, he could have this same strategy work with the will having the shares being transferred to his kids. Obviously, the the spousal rollover, his estate would not be able to take advantage of the spousal rollover and capital gains tax. If there was a gain in the value of those shares, which there probably would be, he'd not be able, his estate wouldn't be able to take advantage of the spousal rollover. So there would be capital gains tax to pay. So it wouldn't be as efficient from that perspective. But depending on a client's particular situation, owning seg funds through a corporation can provide for not just a surviving spouse, but it can be used to provide for children as well, or for other beneficiaries. Quite frankly, if Barney has kids that are spendthrifts, not very good with money, he's concerned about providing assets, in a lump sum. Again, using this type of a strategy with instructions in the will that payments be spread out over time is something to consider, and it is something that might be of use to particular clients. So in summary, corporately owned segregated funds provide a planning opportunity to use surplus funds from a corporation or a holdco for the long-term care of a surviving spouse. And again, that could be extended to other family members. It does provide an opportunity to take advantage of market growth and to protect capital. And of course, one of the great benefits with this strategy is the avoidance of probate, which includes legal fees, lengthy delays, while also providing for loved ones in a tax efficient manner. So that is my presentation.